Laura. I'm a client director at Richardsons, and as I was saying to Rob earlier, I actually did a master's degree in chemistry, so I have a very scientific background, and then I turned to the dark side of accountancy, as I like to say. But because of my background as a chemist, I do deal with a lot of spin-outs and startup companies. And so when I started at Richardsons, that was sort of where I naturally fell. So do lots of work with spin-out startups from Oxford in particular, but I have spin-outs from Southampton all the way up to Edinburgh, so see lots of different approaches across the country. So just really quickly about Richardsons, so you know who we are. So we're a firm of Chartered Accountants. Our offices are in Thames, so just about 20 minutes down the road from Oxford. And we work with a variety of sectors. It's not just spin-outs and startups and technology, but it's particularly Alison, who's here with me today. We do lots of work with healthcare, hence the leg, life sciences and space tech. And we really like to work with companies all the way through from incorporation or even pre-incorporation right the way through to exit. So we've seen companies go through that whole process, and hopefully what I tell you about today will be relevant. I'm talking to you about shares, and that will cover SEIS, EIS and ERS as well, but we also do normal things like accounts and corporation tax and R&D as well. So what are we going to cover? So first of all, a little disclaimer. Everything I'm going to say is about the legislation that applies today, which is the 23rd of October for those of you watching on the video. But the budget is due to happen on the 26th of November. So just a warning, things could change. There has been talk around, I think it was EMI, potentially changing some of the rules around that, but it's just sort of something to be a little bit aware of. But we're going to cover about sort of, hopefully, incorporation through to exit, who gets shares, and sort of the options around reverse vesting and deferred shares, the order your shares need to be issued and the things you need to think about there, SES and EIS funding, sort of future planning on your cap table and how you can manage dilution, employee option pools, later stage funding, employees exercising share options, and then finally just some sort of general considerations and things to think about as you're going through. So to start off with, who gets shares when you start? So it's really important to think about who you're going to give shares to. And we have had clients who have had like 6, 7, 8 founders, and everyone's got shares, and you can have shares and you can have shares. And it's caused problems later on down the line when actually they haven't stayed through past the point of the company being incorporated, and it's caused issues when you've got you're having due diligence on fundraising, and they're like, who's this person, why are they on the cap table, why have they got shares? And I'm not saying don't give people shares, because it's really important to give the right people that incentive to work hard and sort of put the company forward, but it's important to think about who gets shares and how it's structured. There's obviously lots of people who are going to get shares in a company, so you've got your founders, who are obviously your people who have the idea, and you might have their friends and family who might be helping fund the activity, they might put money in. You've got advisors, so we often see spin-outs at giving shares to key advisors, so people who've helped them through that spin-out process but aren't involved in the sort of work they're doing initially, they aren't coming from us as sort of a third party who's been involved. Universities and research organisations often get shares in spin-outs when they've come from there. And then you've also got your general investors. So that's all the way from sort of angel investor all the way through to your sort of much bigger investment corporations. And the other thing to remember is there are ways to give people ownership of the company without giving them shares at the start. So it's just having those options and thinking about it and not just giving away everything too much too soon. So let's start thinking about just about our founders. So in my first example, it's loosely based on some of our experiences we've had, but obviously completely anonymised. Paradigm is going to be incorporated by a group of friends who've had an idea for a company, and they've agreed in the initial setup phase, if one of them leaves, that's fine, they'll just get rid of their shares, they'll give them back. But there's no formal agreement, and as lawyers will know, nothing written down, anything can happen. So over the course of the first 6 months, half the team have left for other opportunities, and each time there was a fresh negotiation on how the shares were going to be given back on leaving. So some of them, the former founders kept their shares, some of them they gave them up and the company bought them back, some of them they didn't cancel them and they were held in treasury, and you end up with a very, very complicated cap table with a lot of people on it who shouldn't be there. So when the company went to raise funds, their due diligence, first thing they came in and said is like, what is this? And they then had to go back and sort it all out, which at this point was about 1.5 years after the sort of date of the first transaction, and get all the findings corrected, get these former founders to sign things off and stuff like that. So it's really important to really think, do they need shares and how are we going to manage it? So another example I have is the opposite. So Pattern Limited is set up by 3 founders, and it's incorporated and one founder gets shares. They then jump into it, they start trading, having activity, signing contracts for work, and the company now is a trading company that's got value, and they've now suddenly realised they need to give shares to these other people, and those people now have to pay market value for their shares, or they have to pay tax on the gift of those shares. So those people have now been hit out of pocket. It's a dry tax charge because obviously they've received shares, but they've not got the money to pay for this tax out of it, and it's put them in a bad position. So don't give everyone shares, but don't forget to give people shares as well. So what's the best way to manage this if you're giving people shares, but it's all a bit up in the air about who's going to stay and who's going to go? Well, the most common thing we see at the moment is using something called reverse vesting and then deferred shares. So reverse vesting, basically you say, okay, you're going to get some shares and you can have them, but if you leave within a set period of time, you've got to give some or all of them back. And then when you give them back, you turn them into deferred shares, and that's sort of the preferred opportunity. And that basically means they still hold the shares, but when they're sold, the whole class of deferred shares is generally only worth £1. So it means it's really easy that they can say, the investors can look into it and say, that's fine, deferred shares, they only get £1, I'm not worried about it. It's really important. It should be covered in your shareholders agreement, and in your articles of association will need customising to allow for deferred shares and things like that. So speak to your lawyers. And really do get legal advice when you are starting out, particularly when there's multiple people involved, because what you don't know will hurt you. So in my example here, if we have Exemplar, which is incorporated with 3 founders, and they have a 4-year vesting with 1-year cliff. So a 1-year cliff is really, really common from what we see. So basically you get your shares issued and you have to wait a year before you can keep any of them. So if someone leaves within a year, all their shares become deferred shares. If someone leaves after 2 years, they'd keep half their shares. And if someone leaves after 10 years, they get everything because it's well past the end and everything is vested. When you issue shares in the company, there is tax implications, and this often isn't thought about in that initial stages. So it's really important to think, are you aware of those tax implications and are you planning around them? So there are ways to plan. This I'm going reasonably high level because it can get very, very complicated, so do seek advice from lawyers and accountants. But in general, if you pay nominal value for shares in a newly incorporated company, you don't have to pay tax on the receipt of those shares. Big asterisks, other conditions may apply. But if IP or other similar assets are being transferred from, say, a university or a research organisation, that's giving the company value, and you can then get caught in a tax charge, and it's a dry tax charge again because you've got shares, the company's increased in value, and you haven't necessarily got money to pay that tax bill. So it is really important, and this all falls under employment-related securities. So that's where you're an employee or a director of a company and you're getting shares, and all the shares you have are increasing in value. Everything can get very taxy. If you're an academic founder, though, there is specific reliefs around the issue of IP into a company. So that's a really important piece of relief, and it can be used to help with the planning of when people get shares as well, because academic founders can get shares later and not have tax implications where other people might have tax implications. And once a company started trading...
Sorry, just briefly.
Yeah, that's fine.
Is the academic founder clause only sort of worked out if there is IP transfer and research?
Yeah, so academic founders relief works if you've generated the IP in the university or research organisation, and it's being transferred from the university or research organisation into your company, then the value of that IP gets discounted when looking at the employment-related securities rules for those people. So if you've got an empty shell of a company that's worth nominal value, and then you just put in the IP and you get shares at the same time, because the IP is discounted, you're basically only being taxed on nominal value. You've paid a penny, you're fine. But if there's other activity that's gone in there, it's only the IP that's removed. So if you've maybe traded a little bit and then the IP comes in, you're taxed on the initial market value of the company that does exist. Does that make sense? As I say, if the company started trading, there's other value in the company, and for that there is generally no reliefs for the tax you might have to pay. So if we look at this as an example, so quite commonly we see a company incorporating with a professor and maybe a postdoc who've researched the IP at the university. They might have we often see key advisors who aren't working for the company, they aren't working for the university, but they're involved and they're going to get shares. The university, in my example here, they're going to get some shares in exchange for IP and some additional investment. And we're going to treat that separately, and then just sort of some general investors. Now, those could be friends and family, EIS investors, angels, or it could be a bigger investment company as well. So As I said, here we go, academic founders relief. So the professor and the postdoc who develop the IP will qualify for academic founders relief. As I said earlier, it's about being transferred into the company as part of the spin-out. They've received the right for the shares because of their employment with either the university or their subsequent employment with the spin-out, and it's due to their work creating the IP. The academic founders relief allows for the transfer of the IP to be ignored when looking at the market value, so it should mean that there's no tax charge on the founders. The key advisor doesn't meet this condition, so it's important that they get the shares before the IP is transferred in if there's any kind of employment-related bit to them getting their shares. So if they're working for the university and they're getting their shares, but they're not going to work for the company, you want to make sure that happens reasonably early. And as the university and the investors are paying market value, and the ERS rules we're going to go with aren't applying to them, there's no concern for them around the timing of that share relief. So if we have our timeline, the first thing we're going to do is we're going to give the advisors the shares. They're paying nominal value for a company that's newly incorporated, and in my example, because they're not going to be employed by going forward, we're not going to worry about future tax rules around that. We can then give the founders shares at the same time, or just after, but at this point, we don't want to have trading before this date. So once after this point, we could start the company trading. However, when the IP comes in, as I said, if it has been trading, there is potential tax implications. We then want to transfer the IP from the university, and we're going to transfer it. That could be transferred with the founders getting their shares as well, because as I said, the value of the IP is ignored, and as long as no activity has happened up until that date, otherwise there's not a tax implication there. Then you generally see the university and the investors, if it's going to come, putting money in at the same time, because you don't want any investment coming from the university to potentially impact the market value of the company, and thereby putting a tax charge on the founders because it can't be ignored. Right, where am I now? SCIS and EIS. So when you're looking at early stage investing, you usually see SCIS and EIS being used. So if you're not familiar with it, it's a government incentive that basically gives the investors tax reliefs for investing in a risky company. And we see it a lot for spin-outs and startups as a way to fund those initial few years, and sort of a really beneficial relief to expose people, and the investors also get a lot of benefit from it with their tax reliefs as well. Companies can raise up to $250,000 through SCIS and fit up to $20 million under EIS, assuming they're a knowledge-intensive company. And the time limit does vary a little bit depending on when you start trading and things like that, which I think I've got on my next slide. No, not on the next slide, it's on the next one. So there's three main steps you have to think about for SCIS and EIS. So the first step is advance assurance. So basically you write to HMRC and say, this is my proposed transaction. Do you agree I will get these reliefs? Now, when you have, if you've maybe got friends and family, they might not be worried about getting advance assurance, or if you're a newly incorporated company, sometimes investors aren't worried. But once you've started having activity, generally, particularly if it's an EIS fund that's investing in your company or an SCIS fund, they want that advance assurance to give them that relief, that comfort that you will qualify. There is, when you go on HMRC, a really nice big green shiny button that says start now, and it all looks very easy to fill in. But if you get it wrong, it can have really bad implications. They can say no, and if you fill in the compliance statement as wrong as well, it can be really challenging. So speak to your lawyers, speak to your accountants, and make sure you are putting the right information in. One thing to flag is to make the application, you need to have at least one named investor, and they need to be investing enough that HMRC deems it not to be speculative. So we had one where they had maybe £20,000 that was agreed out of a £1 million raise, and they wouldn't give it to them because they said it was too low of a value out of the total value. Generally, investors understand that you need them to be named before you can make the application, but sometimes if you're dealing with certain angels and stuff, they don't quite understand why you don't have it yet. So it's just having that awareness. But once you've had the advance assurance, you can then issue the shares, which sounds really easy, but you need to make sure everything happens in the right order. You need to receive the money before you issue the shares, because if you do it the other way around, then you lose your rights to SCIS and EIS. So again, making sure you're getting advice from lawyers and accountants as you're going through this process. And then the last thing you do is you do an SCIS and EIS compliance statement. So basically you send all the details of the transaction that's happened to HMRC. If you've had advance assurance, you send less. If you haven't had advance assurance, you send more, but you have to let them know about any changes that have happened between the advance assurance and the actual application. And then they provide certificates for you to share with your investors that then they can use to claim those tax reliefs. So we commonly see that SCIS and EIS investors want some degree of exit, not preference, but getting a little bit ahead of everybody else. But you cannot have preference shares for SCIS and EIS. It is very common that they have a degree of preference about other people, but again, the wording has to be really carefully done because otherwise HMRC won't grant it. So it's really important to speak to lawyers who understand how SCIS and EIS work, and they can give you the right advice and put the right terms in your shares so you don't get implicated where you've received money, you put in the application and HMRC says no. It's also important that the company understands their responsibilities, so you have to continue to meet the conditions of SCIS and EIS for 3 years after the share issue, otherwise the investors lose their relief. And you also need to make sure you keep all your records for the lifetime that you're claiming SCIS and EIS under. Every time you make an application, you need to know the history of what you've already claimed. So if you don't have that information, it can have big impacts from HMRC going back and saying, well, what you've told me doesn't agree to what we have, so no. And so it's just important to make sure you're keeping that. And we sort of recommend if you've got like a data room or some space like that, just keep everything in there. So even if there's changes in management, everybody knows what has and hasn't been received. So it's quite common, or if you're very lucky, to raise under SCIS and EIS. And maybe if you're super lucky, someone might be raising under nothing. And it's really important to understand that these transactions have to be structured in a way that SCIS is received first, because if you've received any EIS, it disqualifies you from receiving SCIS. So you need to, the simplest way to arrange this is that your SCIS investors' money comes in on day one, have a bit of a space, and then the EIS investors come in on day two. Quite commonly we see that if the raise is such that it's above the SCIS limit, the SCIS is split between the investors and the investors are investing in both SCIS and EIS. And you've got to really make sure that they understand, don't pay everything in one go. Yes, it's a little bit easier, but you're going to lose your tax relief. Pay one, then pay the other. And then the other thing is when you're splitting it, it also then makes it really easy for you to have evidence of the spending that's occurred, so you can claim SCIS and EIS compliance statement, because you have to have spent 70% of the funds under SCIS and you have to have spent 4 months under EIS. I think Alison's confused me with her face, sorry.
Because you have to spend it within 2 years.
2 years,
so
yes.
There's making sure you've earmarked which spend, which investment you're spending.
There you go, exactly. So the next thing is sort of thinking about your cap table moving forward. So when you start, if you've got 3 founders, you might be 33% each. And then when you start to sort of, maybe if you've got the university coming in, you might suddenly go down to 20%. But then as you go on and you raise more money, you're going to go pre-seed, you're down to 10. Series A, you're down to 5.56. You might then agree to put in an options pool, which brings you down to 5%. And you've really got to understand how much you're willing to dilute yourself as a shareholder as the process goes on. I can distinctly remember having a conversation with a client when they were looking to raise funds, basically being like, well, what's your end point where you're going to say no to that dilution? And they were like, hadn't thought about it. They were like, well, they weren't really aware of the fact they were going to be giving up any sort of percentage of their company. And obviously the idea is you have a smaller slice of a much bigger pie, so you're much, much better off. But you need to know from your perspective what you are and are not willing to give up. Have I got, oh, I've got another step. We're now down to 2.81. So, as I say, it's a fact of life. It happens. If you want the funding, you've got to give up something. But you've got to know where's your stopping point, where you aren't going to go any further. And you can, in some instances, manage your dilution a bit with the use of option pools. We see this quite frequently, but it's not going to be able to stop your dilution. It's only going to be able to manage it. One thing to note is business asset disposal relief is a relief for capital gains tax. That if you've got 5% of a company that you've held for 2 years, you're an employee or a director, you pay for the first $1 million of gain at 14%, becoming 18% next year, rather than 24% capital gains tax, which is obviously really beneficial. So when you go below that 5% threshold, you obviously lose your access to that relief. And you can make an election to basically crystallise that business asset disposal relief, so you get that at that point. And so that's something just to have a think, to sort of have an awareness out and consideration that you can elect to do that, so you're going to pay less tax on that amount of gain. So in terms of managing dilution, so if you agree on option pool, you can see you're going from 19% for founder one down to 16%. Now it's obviously not immediate dilution because those shares haven't been issued, but it's potential dilution that you're going to lose some of your shares to that. Now, option pools are obviously really, really valuable. You can use it to incentivise your employees, and I'll touch on that in a second. But here it's more focusing about you can use that option pool to help manage that dilution of those individuals. And so in this case, we've kind of showing that, yes, they've basically agreed that their option pool is going to keep them at the same level as they had after post-investment with the option pool. So the founders are losing that dilution. No, I've lost the word. Anyhow, there you go. That's that. We'll give up. But in terms of option pools, the main use of option pools and the biggest thing we see is employee option pools. And they're obviously a really valuable tool to incentivise your employees without having to put any cash out. So when you're an early stage spin out and you're really strapped for cash and you want people to really feel like they've got a in your company and they've got to work for it, that's what you want to use the option pool for. It's where you can't pay for a Christmas party. Well, here, at least you can have some shares in the company that you're working so hard for. There are two broad categories of options that you see. There's tax advantage, which basically means that you don't pay tax or national insurance on the exercise of the options, and unadvantaged options. Now, tax advantage is more restricted of what you can do, who gets it, and unapproved, you can pretty much do what you want with it within degrees, but there's obviously tax implications of what happens. EMI is the most commonly seen tax advantage scheme. So as I said, you don't pay tax or national insurance on the grant of the options, you don't pay on the exercise of the options as long as certain conditions are met. And there are some requirements. So employees, they have to be employees, they have to work more than 25 hours or 75% of their working time, and they cannot be beneficial owners of the company. And the company must have gross assets of less than 30 million or less than 250 employees. So for your small companies, early stage, you're probably going to qualify for EMI, and you're hopefully going to have the employees that you can give that to. So what's the process of issuing EMI options? So the first step you have to do is you have to agree a valuation with HMRC. And you use this fun form called a Val 231. Now again, it's a big shiny green start now button, so it is tempting to try and fill it in yourself. But it is really important that the valuation wording is correct. We've had a lot of instances where wording has been put down and it's trying to explain something that's completely valid, and the valuation they've got is correct, but the wording they've used is like a red flag for HMRC, and they've come back and they've questioned it and they've fought and they've fought and they've fought. So it is important to make sure that you are getting the lowest value you can agree that is appropriate, but sometimes if the wording just isn't quite right, HMRC pushes it up, and then that obviously impacts your employees in that sense. But basically, hopefully, you send in your Val 231 and HMRC confirms your valuation. You then issue your options to issue your options to your employees, and they must be in 90 days from the date of HMRC's confirmation, because HMRC obviously only agrees that valuation for a set period of time. Now, I'll touch on what happens with the granting in a couple of slides' time, but then you have to report to HMRC, and this is something where we often see getting missed, and if you don't report, you lose your EMI status, so it's really important that you do report your options to HMRC, but also people leaving it too late and then suddenly having a mild panic on the 6th of July that they've got to do something, they don't have the right logins, and how on earth are they going to make it happen? So if you're issuing options, set up your HMRC government gateway, add ERS to it, make sure you have it. You don't have to submit to the 6th of July if you like to live life on the edge, but at least have the right logins. So you have to, in the 6th of July following the end of the tax year, when you've granted options, you have to report that grant, and it's a different report for each date that things have been granted. And then also at the end of every tax year, you have to make an annual confirmation about options that have been lapsed, exercised, or other changes. And the most common thing we see here in terms of other changes is if you've split your shares from a penny to 1,000th of a penny shares, you have to report that your options are now over 1,000th of a penny shares, not penny shares, and maybe the exercise price has gone from 2p to 2,000th of a penny. But that's that. What is it? Oh yeah, keep your records. We often see clients who have due diligence come in from investments or as they're looking to exit, and they're asking to see all the details of have you reported to HMRC about your EMI options, and nobody has any details. Having incorrect filings can also obviously have issues with HMRC, so it's making sure you keep those records of what's been granted to HMRC and things like that. And if you're getting an accountant or a lawyer to make those submissions for you, make sure you're asking for those details from them so you have it and you have that evidence that you know it has been made.
Is there any way of retrieving the evidence?
No. Which is very frustrating.
Yeah, quite for an organisation like HMRC.
You would think so. Well, HMRC has 2 computers that are physically incapable of speaking to each other, so in a way it doesn't surprise me, but they have no way. We are where we are. So we've tried for clients before to contact HMRC and say, well, they've just submitted it, we want involved, can you give us the details? And they just go, no, sorry. But it makes you think, potentially, can they link everything up? But you can't retrieve it, unfortunately. Hopefully they'll improve the system where you can access it and see what has been reported. Because obviously we find when we take over from other accountants and stuff, if we haven't got the information, we have no idea what's gone before. And then you might miss correct reportings about lapsing and things like that if you don't have those details. So yeah, petition HMRC. I'll sign your petition.
Comms issue exists between staff as well as their computers.
Oh, absolutely, and between floors, so you're also talking to other government departments.
Yeah. Oh yeah, no, yeah.
As an immigrant, there is an issue somewhere in there too. But
Yeah, there's lots of issues, but unfortunately I don't think we're going to be able to fix them tonight.
no.
Storm HMRC's offices tomorrow. Okay, let me figure out where I'm at now. So Illustration is going to agree with their investors a tax pool of 15%. At the moment, they have 4 employees that they want to give options to, but they're expecting in their growth plan over the next 5 years to have 40. So if you give all of your options pool to those 4 employees, you're left with no options, like no chance going forward, as if that's the maximum the investors are going to give you. So you need to think, what am I willing to give these people and when? Now, at the very early stages, you might give people more options because they might be less well paid, they might be getting less other benefits. You don't throw them a good Christmas party, you just go down to the pub and buy them 1 pint. But you've got to really think about that and have that planning ahead. And obviously, as you get more investment, you might agree a bigger option pool as it goes, but sometimes investors don't want that option pool to expand. So you need to be able to plan that out. You also don't want to give all the options to your employee and not be able to give them any more when you may want to. So that's basically what I've just said. So if we say our expected staff levels are 4 members of senior management, 6 technical managers, 10 admin people and 20 technicians, and we think about our total option pool of 52,000, how are we going to split it across those people? So you're obviously going to want to be able to give more options to your senior management potentially than your technicians, and it's thinking about that. So that kind of gives you per person a maximum of what you're wanting to give. So if we have at the start just 4 technicians, we can give them, say, the full 712 shares we've technically allocated per person, but you might also want to give them, say, 100 to begin with. And then next Christmas, when you can't throw them a Christmas party, you give them another 100. And they can be used as bonuses. So we see a lot of companies where, as part of the bonus package, it is around options. So it's thinking about every year that you're going to be issuing more options to people. But if your option pool is not going to grow and grow and grow, you need to be able to manage that as well. So this is the slide I referred to earlier, but it's a lot further on than I thought it was. So issuing and granting options is quite a time-consuming process. You need lawyers to draft the grant agreements, you need accountants to help you with the valuation and the reporting, so you don't want to be doing it every 5 minutes or every 90 days as your HMRC valuation runs out. So what we commonly see, and I think this is something that people don't necessarily think about initially when they're granting options, but your lawyers will know to do this, is your vesting start date doesn't have to equal your grant date. So you could grant options today, but they could have started vesting a week, a month, or a year ago. So effectively, if you've got 1 year cliff and this vesting starts a year ago and I issue options to you today, you've then got those options vested immediately on grant of the agreement. So you can do this to say, okay, well, if we agree that in our company, after your probation ends, you get your first tranche of options, you can then do once a year, grant all those options, but the vesting dates be backdated to when this probation ends. So in my example, we have Standard Limited. They're going to give 10% of their maximum option pool to everyone when their probation ends. And then at each anniversary, they can get up to another 5% if they meet their targets. And once a year, they complete a Val 231, agree the valuation, and then grant the options to their employees. So, as I said, your date of grant and your vesting start date don't have to be the same. Your vesting period is obviously the period over which the conditions that your employees have to meet to be able to get those shares occurs. We usually see time-based vesting, so you just have to be here for long enough time. But once you start looking at senior management, you might put on target-based conditions as well. And for EMI, employees have to meet the conditions of EMI for this whole period to be able to have them. So if we have our weird, slightly strangely named employees and their start date and their probation, and you'd grant it all today, but this would be the vesting start date in the agreement, and they'd all look slightly different. So a couple of watch outs and considerations. So be careful with good leaver clauses. They're great. You want people to feel incentivised to do it, but you don't want everyone to get equity necessarily. You don't want to end up with a very, very complicated cap table because you've had lots of employees leave and you've let everyone keep their options and exercise them. We have a lot of clients who EMI options can become unapproved options when they leave, so they still have the right to buy them maybe at an exit but not holding shares continually. And some clients, they just say, you leave, that's it, you've lost them. But it is really having those thoughts and thinking about what your future planning is and how it's going to look like. Most external investors will expect you to pass the employer's NIC liability onto the employees. Again, this is something that will happen when you do your grant. Your lawyers will have probably advised you on that if they're helping you, but it's just something to be aware of. And another thing just to be aware of is EMI used to be really, really great when they were paying 10% tax on the capital gain. It was way less than the income tax they were paying. With the rate increasing up to 14 and now 18%, it's still better than cash bonus, but it's just that thing to be aware of. It's not quite as beneficial as it might have used to be. So, later stage funding. So this is the graph that everyone has. This is my version of it. But as you sort of go through the company's life cycle, you're looking at different sorts of investments. So pre-seed, you're looking at friends and family and angel investors. Then seed is angel investors. You might look at EIS funds. Early stage, you're looking at VC. And then later stage, you're coming into private equity. And we're really thinking about the gaps that can occur here. So between your pre-seed and your seed could be a very big gap, and you might need to extend that funding. And again, between seed and early stage, it might take you 10 years to get to that next stage, and you need to know how you can get funding in that period. Is that what I've said on there? Yes. So for EIS, the standard period is 7 years from the date of the first commercial sale. Again, it's something to be aware of when you're reporting it. I've had clients who reported to HMRC the date of our first commercial sale was the day we incorporated, but they didn't make a sale for 12 years. So how have they made a commercial sale on the first date of incorporation? But HMRC thinks that's when they made their first commercial sale. So it's something to just be aware of. Companies that are knowledge intensive, so you meet certain conditions, have up to 10 years from when their commercial sales exceeded £20,000 to raise funds under EIS. So again, it's making sure you keep those records, you know when that's happened, you know when that's been reported to HMRC, so what HMRC thinks it is. And unfortunately, HMRC on EIS, they can communicate with themselves and they do know what you've told them. Companies can raise after this limit if the funds were raised in the period and the new monies were raised for the same activity. So if you claimed EIS in your initial qualifying period, in that application you knew you were going to need future funding, you can then continue to claim under EIS, and I think it's called Condition B. There's also another thing where if you change what you're doing, you can claim EIS anew, but you do need to have awareness of your previous EIS claims you've made as well, because HMRC looks at that for your lifetime of raises as well. And it's making sure the timing of that, if you do decide to go into a new market or something and are going to raise under EIS, you can't start that activity before you raise that money. You need to raise the money before you start the activity. So, oh, my battery's running low. That's no good. We're almost there. So blueprint, developing a new technology. So incorporated in 2010, first commercial sale in 2012, sales exceeded in 2014. So the initial 7-year period was to December 2019. We're going to say the company's knowledge intensive, so they've got 10 years from the 2014 to 2024. So if they complete the following fundraising, so in 2010 they raised 100,000, 2016 500,000, and 2024 250. They're below the lifetime limit. As long as this application said they're going to need future funding, they can then continue to raise under EIS for a raise, say, completed in 2025. So, employees exercising options. So, we've been seeing a lot of this recently, so it's something that I thought was worth including into this. So, really, the terms of the option agreement are going to dictate how and when employees exercise share options. So, if the option agreement says it's exit-only vesting, well, exit-only vesting, yeah, that's right, they're not going to be able to exercise their options. But most of companies where if you've got time-based vesting and options have vested, they can be exercised when they leave, as long as they're a good leaver. But it's understanding what the terms of your share option agreements are, because we've had clients who've been very confused as to what they need to do and why. They have 90 days to be exercised after an employee ceases to meet the conditions, so there's a bit of time for people to think about it, but it's having those conversations with leavers so they do know what they need to do. Usually a Section 41 election is signed on exercise. I believe it is a deemed notification, but most people do physically sign it as well, so they've got that clear paper record. And effectively what a Section 41 election does is it accelerates the tax charge of the shares for the difference between the actual market value and the unrestricted market value. So the actual market value is the value of the shares because restrictions apply to them. And it's basically treating everything as being acquired at the unrestricted market value. It's a little bit complicated and people get very confused when they have to sign it. So again, it's speaking to your accountant, speaking to your lawyers, making sure you know what you need to do. So considerations, and then if my laptop dies after this, we're fine. So the biggest thing is keep good records. So that's things like resolutions for issuing shares or expanding the option pool. I recently had a client go through a big fundraise and they were having to scramble around trying to find all the resolutions for the increase of their option pool, and they'd sent some of them to us but they hadn't sent others of them, and then the option pool got decreased at one point. It didn't have that paperwork. So it's really having all those records and keeping them in a place that everyone's going to access, and if senior management come and go, everyone's going to know where everything is. A big thing is keeping details of ERS transactions and submissions. As we said, HMRC doesn't let you see them again, so it's making sure you have them. They're often asked for. My biggest thing is seek professional advice. Speak to lawyers, speak to accountants. It's never too soon to speak to someone. We often speak to companies before they've incorporated, and I'm sure the lawyers in the room do too. I can see some nodding. So you've got to make sure that you're getting that advice and you're doing things in the right way, because it's much easier to do things right the first time and cheaper than to get it wrong, have to fix it, because sometimes it can't be fixed, sometimes it can, but it's going to be very expensive to do so. Try to avoid complex share capital structures. As the company grows, it is going to become more complicated. You're going to have different classes of shares and things like that. But when you start off, keep it as simple as possible. Don't make it harder for yourselves than it needs to be. Plan ahead, think about what your maximum dilution you're willing to have is, and really think about sensible agreements between the shareholders that exist now so that you've got a good base and a good footing going forward. The other thing is perform regular health checks. I'd recommend around April, you might need to consider whether you've had any employment-related securities transactions anyhow, so it's a great opportunity to look through all your shares, and your accountants and your lawyers will sure be happy to help you with that as well. But make sure you have all your records, that everything is in there. A lot of our clients have like a data room type space that they keep those records in and they know that they're there. And also make sure that filings agree to expectations. If you've issued shares and maybe your lawyer or your accountant have done the filings, get someone just to go on company's house and check everything's there. We've had a client who we started auditing them, realised they were missing a share filing, still not put it on there. So it's now going to get later and later, and at some point they're going to have to put it on there because someone's going to want to give them money and they're going to be like, it's not there. But it's, again, really important to make sure you've got everything. Things are showing up in company's house. And if you're not sure, seek advice. So this is what I said I was going to talk about. And hopefully we've covered everything there. And that is the end. And now my laptop can happily die.